All right, good afternoon and good morning, everyone, to our special webinar, Convertible Notes Q&A. This is a special second webinar to follow up on last month's webinar on convertible notes. It's going to be a shorter than usual presentation today, just to give you more time to ask questions to our two expert panelists today, specifically around convertible notes and how they affect you specifically as a founder and entrepreneur. So before we get started, please take a look at your GoToWebinar control panel. You should see a section that says questions. We will be answering questions that come in through that particular panel. We'll save most, if not all, of those questions for the tail end of our presentation. So go ahead, if you've got questions already, go ahead and start pumping those in, and we will do our best to answer as many as possible in the hour allotted. So my name is Jason Kennedy from Early Growth Financial Services. I'm your moderator for today. And without further ado, let's meet our panelists, starting with Sirk Rowe, a Principal and Consultant CFO with Early Growth Financial Services. Sirk, say hello.
Hi, everyone. Thank you very much for joining us. It's great to get the positive feedback from last month's webinar. Just a little bit about Early Growth Financial Services. We are a full-service accounting and financial outsourced consulting firm, and we typically work with small and medium-sized companies, which here in the Bay Area and in most of California means tech startups. And we basically provide four types of services, or four different products, services. And that is, we do annual tax returns, so corporate tax returns. We do company valuations, so particularly for companies who are giving stock options, you need to be valuing the value of the stock options on an annual basis, and so we provide that service. And then on a consulting basis, we provide both accounting and bookkeeping services as well as CFO level services. And typically we go in as a team of two, a CFO and a senior accountant, and we'll basically become the accounting and finance department for our clients, such that you can use us on an as-needed basis, save the hard-earned cash and the hard-raised cash that you have for more important business needs, as opposed to hiring people full-time. And we'll typically work with companies until they have grown to the point where they need to be, and it makes sense for them to be hiring people full-time.
Great, thank you very much, Sirk. Also with us here, Kevin Smith, founder and CEO of SEEDCHANGE. Kevin, good morning.
Good morning, good afternoon, everyone. Thanks, Jason. A few years ago, when I left a large investment manager to start SEEDCHANGE, our goal was to take processes and procedures and ways of handling securities that people are used to in the public securities market and bring those into the early stage investing market. We thought we could make it a faster, more efficient, cheaper, and more transparent process for both investors and early stage tech companies that were looking to raise funding. One of the first issues we came across was convertible notes. Convertible notes are a little bit deceptively complex, and we found that nobody, even people who've got a lot of familiarity with investing, who've been managing portfolios or doing investing for years, decades even, had a real handle on the way convertible notes work. And so we spent some time figuring this out and also figuring out how to convey our knowledge. And so it's a real pleasure to be able to pass along what we think we've figured out over the years.
Great. Thank you very much, Kevin. Thank you both for joining us. For all of our attendees, as I mentioned briefly at the beginning, this is going to be a bit of a truncated presentation, as we want to leave as much time as possible for actual questions. So we're going to hit the high notes here on convertible notes and jump into a couple examples and then questions. Convertible notes, as most of you may already know, debt that acts like equity, functioning as legal IOUs, but repayment in stock, typically instead of cash. And because it's debt, it has certain features such as interest rates, maturity dates. We're going to talk a little bit about that again at a high level here in just a moment. But first, Kevin, let's just talk about the benefits of convertible notes.
Yeah, why would you do this? This is a sort of a recent development in the history of early stage funding. Recent in the sense of only in the last, say, 15 years has this been really common, and I would say only even in the last 6 to 8, maybe 10 years max has it been generally accepted. At least across most regions of the United States, where investors regularly seek out startups to invest in. The advantages are the reason they've sort of surpassed issuing equity at the very early stage is they're quick, they're short. A typical convertible note purchase agreement and the note itself might add up to 5 or 6 pages. A typical stock purchase agreement, even for a very small amount, is probably 50 pages or so. And the number of pages has a direct correlation with the amount of legal fees you're going to pay in order to get this out. So the fact that it's short, that it's simple, means you can turn these around really quickly and pretty cheaply. It also acts as kind of a just-in-time funding mechanism. So with equity, the normal procedure is to corral as many investors as you can, put them in a holding pen until everybody is ready to fire off the funds and exchange documents on the same day. And the term, herding cats was invented precisely out of this kind of process. It's a terrible, complex, and nerve-wracking process. Convertible notes let you do this anytime. You can issue a convertible note today to a single investor and issue another convertible note next week to a different investor, and you can't do that with equity. Another big advantage is because this is debt, it's not equity, you don't have to go through the negotiation process, which I think particularly for an early stage founder is an advantage, because in any negotiation you're probably going to be at a disadvantage. It's probably the founder's first time doing this. It's probably the investor's 10th or 20th or 50th time doing it, and most every time you're going to come out on the short end of that negotiation process. And then last, really an outgrowth of the short, simple, and flexible. Convertible notes have really coalesced around a series of standard terms. There's not much to negotiate here. Almost every convertible note in the United States, at least, comes out with the same terms, more or less the same numbers, and again allows you to save some bucks and save some time.
No, thank you very much, Kevin. The really big thing for me on this is the flexibility and closing of any time, because what happens a lot is that we need some cash, right? And someone is willing to put in a little bit of cash, but it's probably not going to be enough for you. But the ability to close that financing with a very, very simple agreement, get some cash in the door, and then 2 months later, 3 months later, whatever the timing is that you need more, you're able to just go out and find another investor or a follow-on from the same investor and just be able to bring in money as needed is a huge benefit, and allows a company to progress further along without the hassle and also the worry and the stress of trying to close an equity around the financing.
Awesome. So moving on a little bit and drilling down a little further, talking about the terms that matter. We've got the 4 big terms there, but let's drill down a little bit into each one. Kevin, starting with it's convertible notes, so it requires an interest rate, right?
It does. It's still a debt instrument, and because it's a debt instrument, it must pay an amount of interest. The weird part is that investors rarely invest in a convertible note in a technology startup because they care about the interest payments. And so what you find is that often interest is really nominal. We generally recommend that you go about it in one of 2 ways. Either you choose a rate that's tied toward an acceptable rate like LIBOR, or choose a number that's quick, simple, easy to administer, like 5% or 3%. In the very low interest rate environment we've been in over the past 3 or 4 years, a rate like 3, 4, 5% is generally accepted. And again, this is not an item that you find an investor that much cares about. If you do find an investor that really cares about this, you probably ought to turn to the next investor. This may be a red flag about the approach that investors got toward making this investment. The note term is the due date, and because it's a debt, again, it's got to have a maturity date. Typically, we use 18 months. And I say typically because some states have maximum terms that are allowed for convertible notes, particularly in this kind of this scenario. But you also want a term that's far enough out that gives you some flexibility. What happens if the note matures and you are not yet ready to convert to equity, nor, of course, are you ready to repay? And again, because most investors are doing this, making this kind of investment, not in their minds because they're looking to get principal and interest, but because they're looking to get capital gains from the growth in the value of the company. They're not generally interested in getting repayment. What they want is conversion to equity. And let's say 12 months goes by, you're not quite ready for that next round, but you've got a 12-month term. What do? You probably go back to investors and negotiate an extension, amend the note, and give yourself some more time. The other way is give yourself some more time on the front end. Don't do a 6-month or a 12-month term. 18 or 24 is much safer.
Yeah, it'll always take longer, and so even if you're absolutely sure that you're going to close an equity round of financing in 12 months, it still makes sense. To Kevin's point, it's not even a probably do an extension. You will do an extension because by that point you'll probably not have money to repay that note if the maturity date comes up, and so you will be doing an extension again, just more negotiation, more paperwork, and a little bit more legal fees associated with that. So just save yourself the hassle and negotiate a longer maturity date up front. You shouldn't really get any pushback from investors on this one.
The last two terms really work in tandem, the discount and the note cap. And what these are meant to provide is a little bit of a kicker for that investor that's making an investment at an earlier round, an earlier stage. So given the additional risk that an investor is taking on, the investor is going to get a little bit more of a payback than a slightly later investors. These two terms work in tandem because an investor gets to choose at the time of converting the convertible note into equity whether to convert using the discount or using the note cap. Discount means very simply that if in the next round, the equity round, if the shares are being issued at $1 a share, the convertible note holder gets to buy those shares or convert those shares at a discount to $1. The discount's usually 20%, which means those shares are going to be issued to the convertible note holder at a rate of 80 cents per share. Now, the alternative is what happens if at the next equity round you've been fabulously successful and you've not only hit all of your milestones and targets, but you've blown through them like a rocket. And you were hoping for a valuation of $12 million for your Series A. Instead, you realize you're going to be able to get a valuation of $40 million. That has a potentially deleterious effect for an investor in a convertible note because now, despite the fact that note holder took on some pretty considerable risk, by investing in a really early stage, that note is going to convert at a really low rate or rather a really high price, relatively speaking, for that note holder. And what the note cap does is essentially put its dilution protection for the convertible note holder, allows the note holder to choose to convert as if the valuation were the convertible note cap rather than the actual valuation. And we'll show you using a spreadsheet how that plays out, because I think it makes more sense with the numbers. But the important thing to remember is that the investor gets to choose discount or note cap. Discount, totally standard. It's almost always 20%. Note cap, there are more or less medians, so kind of standard numbers for companies at a particular stage as well. So not a lot of negotiation or concern with those, but it is an important feature of the convertible note.
All right, I think you mentioned spreadsheets there. If you're ready, we can switch over to some examples, and let's see if we can kick this over now.
Yeah, let's do. So what we did, we actually put together, as I said, when we were starting out, we found that even really experienced and generally sophisticated investors didn't understand how their investment was likely to play out, particularly using a discount or note cap. So we created a spreadsheet that we distribute often for investors in early stage companies. In fact, we went on and developed a patented modeling tool that we use on our website for registered investors. It allows them to see, if I invest $100,000 in this round, how does that play out? What do I own? This is a question that investors have a lot. What does that mean? What do I own? And what am I going to own, in future rounds? Let's walk through here on the $4.5 million valuation, which is roughly the median for an early stage company with just a little bit of traction that's issuing convertible notes. And we kind of deliberately chose that number because it's close to a median. But we also brought in some other numbers that are, not round numbers, in order to better illustrate how this plays out. Jason, if we can look at the $4.5 million valuation tab, we'll see what happens. Let's assume now, again, that you've chosen all of the standard terms in your convertible note, and that you've got a convertible note valuation cap of $4.5 million. We're also assuming that one of the terms you typically include in the convertible note is what's the trigger for converting. There's the maturity date, right, which is 18 or 24 months typically. There's also a number. So the next time the company raises a round and issues equity in a certain amount, and the most common number is $1.5 million. That's what will trigger conversion of the notes to equity. And so we've used that. We've assumed that as well, that the note converts after an equity investment of $1.5 million. In this model, we excluded the 5% interest that's payable to note holders. That's almost always paid out in stock at the time of conversion. It should never be paid out in cash. But for the purposes of this model, we didn't include the 5% interest that would accrue. And then also, we didn't assume that there's an option pool, and there almost certainly should be an option pool. But for the sake of simplicity, we've excluded that here too. So looking at the left column, let's assume that the company currently has 8.5 million shares outstanding. that you are looking to raise a total of $575,000. You're using the standard 20% note discount and a roughly standard $4.5 million note cap. And at the Series A, we're assuming that you're only going to raise the minimum in order to convert, that is $1.5 million, and that the valuation at that time is $4.5 million. Now, note that the valuation at the time is the same as the convertible note cap, $4.5 million. And that's important because that really results in it provides the calculation for whether an investor will choose to convert under the discount scenario or under the convertible note scenario. Remember, the investor doesn't get both a discount and a cap. You got to choose. Looking at the second column, the discount column, you can see that at the time of conversion, which is the time of the Series A investment when the company has raised $1.5 million, converting under the discount would lead to a share price of 36 cents, giving the note holder or the note holders who collectively have $575,000 in notes, 1.6 million shares, almost 12% equity, and a 1.25x return. Not a terrible return, assuming that this takes place in 12, 18, maybe 24 months. Now, if we were to apply the cap instead of the discount, you get a different result. You get a higher share price, fewer shares, therefore a little bit under 10% total ownership, and of course a 1x return. So naturally, under this scenario, Series A investment of $1.5 million at a valuation of 4.5, the investor is going to choose to convert using the discount. And if we go on to a different valuation, and the next tab shows a valuation at Series A of 50% greater, what happens? Looking at the second column, the discount column, you see it's just straight 20% discount off the share price in this round gets a share price of 57 cents, a million shares, 8.71% equity, and again using the discount, 1.25x return. So not a terrible return, but it already starts to widen with comparison to the cap. And looking at that column, you see that converting at a $4.5 million cap in a $6.7 million valuation gets the note holders 1.2 or almost 1.25 million shares, a nearly 2% greater holding, and a 1.5x return. And again, just to make clear, what's happening here is that the conversion takes place as if the valuation of the company in this round were $4.5 million, because that's the convertible note conversion cap. So it doesn't matter what the valuation is, what the actual valuation of the company is in this round. The note holder is going to convert using the cap, so long as the cap is less than or equal to the valuation of the company at that round. Let's skip ahead to the very last tab. This tab kind of assumes that we've done quite well, and we were hoping for growth. We always do between seed and Series A. Nonetheless, we're still doing an investment of $1.5 million, but at a valuation of $13.5 million. So pretty dramatically different. And here's where the contrast between the way the discount works and the application of the cap to convertible note conversion becomes really stark. So again, with the discount, you're going to get a 1.25x return, 20% discount off the share price. But using the cap, converting during an investment round where the company's valued at $13.5 million as if the company were valued at 4.5 million, at least for the purposes of the notes only. Produces a much nicer return for the note holder, a 3x return, 11.5% total shares, and so you can see how this plays out for the investor. And lest you think that this is really only in the investor's interest and it's sort of a zero-sum game, it's not. This is actually in your interest as well, as a founder of a company, because what a note cap does that I think is really important and kind of overlooked sometimes is it aligns the interests of the convertible note holder with the interests of the founder, i.e., you would both like the company valuation to grow as much as is feasible, and you would like that. That's obvious. But with a convertible note cap, the investor would like that as well, because the greater the valuation, the greater the investor's return, at least round to round, paper returns, which would not be the case if we didn't have a note cap and we were only applying the discount. And what you've seen in the past is that when convertible notes were issued without a note cap, using only a discount, you find that investors are kind of acting counter to the interests of the company itself, because at least for the Series A round, they really don't want the valuation to grow much in order to convert and take a bigger stake. After which, of course, they'd be delighted for the company to grow, and they'll do everything they can to help grow it and get to a higher valuation. But by beginning with a conversion cap, you align the interests right from the start, and it's a better payoff for the company as well as for the investor.
You know, you can really see the actual math. It's kind of hard to see it when you're looking at each of these tabs separately. But as you kind of go from the different tabs, you know, Jason, if you can kind of focus everyone's attention on the cap table ownership part of the chart on the 13.5 million, you can see that, you know, under this scenario, that the note holder has 11.5% and the team has 78.5%. And if you kind of go back down, you know, maybe even to the 6.75, you can see what the difference is, right? So that the note holder has only 10.45%, but the team only has 71%. So it's really, as the valuation increases, basically what happens is both the note holder and the team you know, basically do better at the cost of the new Series A investor. And so again, to just reiterate, you know, Kevin's point about this really aligns the note holder and the team, the management team and the founding team, to increase the value of the company at an earlier stage as opposed to after the Series A round of financing. It puts everyone in the best position possible.
All right, fantastic. Thank you both there. So without further ado, let's jump into the questions. We've got a few waiting for us already, several in fact. But for those of you who have questions that haven't asked yet, please use the questions panel there on the webinar console. As I mentioned before, we'll get through as many of these as possible before the hour is up. So we'll jump right into it. We'll start asking questions here, gentlemen. First up, what are the typical arguments against convertible notes that entrepreneurs need to be prepared for?
I think there are a couple. The first is less and less common, and that is that investors in technology companies really aren't familiar with convertible notes, want to do what they're used to doing, which is equity. As I said, this has become a very widespread instrument. At some point, you know, maybe 2, 3, 4 years ago, we pulled some data that 90-some% of all seed stage deals done in the United States were done using convertible notes. So it really had had kind of won the day, and investors generally just accepted the idea of convertible notes. I think there are still some pockets around the United States, and I think they're generally in the Midwest to target a geographical area, but also sometimes in other even places like Silicon Valley, LA, New York, which are generally kind of centers of early stage investing and finance. But if you're going to an investor in even those areas that's not familiar with technology investing or startup investing, you're still pretty likely to run into somebody who is going to be much more inclined to do an equity deal. The other objection, and I think it's a related one, is that sometimes you'll find that investors will say, I don't want debt, I want to own something now, and I want to value what I own now. And so, particularly if you're getting investors that are not common, not frequent startup investors, you may find somebody that says that they're very familiar with convertible notes. They understand the way they work. They understand the pluses and minuses. And nonetheless, if we're going to do this investment, they want a valuation as of today. And I think the answer to that, really it comes down to how comfortable you are with going through that. If you're trying to raise a couple $1 million, you really must raise it. You've got somebody who's willing, or a group that's willing to put in $1 million of it, but only if it's equity. You might decide that it's going to be worth the cost, the trouble, and the possible sort of downside of having to negotiate a valuation at this early stage. I think the other argument, though, against it is that valuations, particularly of private companies, are tremendously difficult. And if you're trying to value a very large, long-established company, it's still a difficult process. You can still get 3 valuation experts that may come up with pretty disparate valuations, even with that kind of track record. Talking about a startup company, you don't have a track record. There isn't a valuation kind of business. So valuations become sort of a combination of let's take some numbers, figure out how we what kind of multiple we apply, and then let's argue about this for a few weeks. And I think an argument is that it's a very arbitrary number. You're never going to come up with a valuation that's fixed in any sort of science, and therefore an investor may be disadvantaged as well at doing an equity round for a company that's only got a valuation of a couple $1 million at best.
Yeah, I think even in the Midwest, I think more and more investors certainly in the tech arena are very, very familiar. You may get a little bit of pushback to Kevin's point about them understanding it and not wanting to do it. But we're seeing less and less cases, almost none now, where an investor is interested and they say, "I don't understand why we would do a convertible debt as opposed to equity, and please explain it to me." And you need to educate an investor. So that's really not what we see anymore. I think if the investors really are adamant that they want to do an equity round of financing, then you have to wrap your head around, okay, well, how clear is this investment team going to be coming together? Are we going to actually be able to negotiate a deal on terms that you are comfortable with? And if you are, then I don't see any downside to it other than the risk associated with trying to close an equity round of financing instead of a quick and dirty or quick and clean, in this case, convertible debt.
Great. So we mentioned seed stage a couple times during this presentation so far. Is there a sweet spot for convertible notes? Is it you typically for seed only deals? Do you ever see convertible notes in any subsequent or later rounds?
You bet. Convertible notes really started out in the technology space as sort of bridge rounds. So you've already done a Series A, you're getting ready to raise a Series B. It's going to be a $20 million round, but in the meantime, you need $1 million because whatever, it doesn't matter why, and you're not quite ready to go full on raising the full 20 million. How do you do this quick and easily? And maybe 20 years ago or so, people started using in the technology company space started using convertible notes really commonly for that sort of bridge round. And at some point there was an aha moment when people, I think, got the concept that, wow, this is so convenient for bridge. Why should we not use it for the full round? And that's when it kind of moved down into and ultimately became the de facto investment instrument for seed stage. But people still use it for those later bridge rounds for the very same reasons.
All right, fantastic. Another question here, is there a maximum amount that's financed in convertible note deals?
Not really, but there is sort of meaning not really in the sense of there's nothing stopping you from doing a $100 million convertible note if that's what you want to do, and indeed public companies do convertible note convertible note fundraisings in the hundreds of millions of dollars. That's obviously a bit of a different process, a lot more expensive for the company, and certainly a lot more expensive in legal fees. In the tech space and the startup space, it's kind of uncommon to do a deal for more than, say, $1.5 million, maybe $2 million in convertible notes. You get beyond that, you're talking probably about a pretty substantive round, and you're probably more likely to be doing issuing equity, and that happens to align with kind of the rounds. So if it's seed, you're probably doing a lower, raising a lower amount, therefore convertible notes make sense. If it's a later stage, if it's a Series A, B, C, you're probably raising a much larger amount, therefore you're doing equity, not convertible notes.
Okay, great. And tying into the spreadsheets we had a little bit, we looked at earlier, what if the price round comes in lower than the cap?
Well, then you probably are going to, not probably, you're certainly going to convert using a discount. And that's the point of the discount. What happens if you've got a convertible note of 4.5 and God forbid, but it hasn't been a great year, you've pivoted twice, you finally hit on where you think the company's going to head. You've, in fact, convinced investors, but the fact remains that the company is just not as valuable today as you had projected it's going to be, and you're only going to be able to get a $3 million valuation. So the note holders will convert in that round with the 20% discount.
Yeah, and this happens a lot. It's obviously this is not what we want to see, but it happens. It's very, very frequent. Things don't go according to plan, especially for early stage companies. We do see a lot of pivots, and that's a good thing. Being able to pivot and making changes as we go along is a good thing. But typically, what that means is that we've burnt a little bit of money, kind of along the way, and when we go to raise that round of financing, we're probably not as far along as we would have liked to have been, and where we were planning on being when we raised that note. So it shouldn't be discouraging. When that happens, it does happen frequently. And in that case, to Kevin's point, the calculation is the same as you see on these spreadsheets, and it'll be a very, very clear. The answer will be very, very clear and obvious that it's you're going to base that pricing on the discount.
All right. So when does the note typically convert? Is it for against the pre-money valuation or the post-money?
The calculation, all these calculations are based upon the post money valuation, and when you say I guess fully understanding the question about how it's being valued, or what it's being valued against.
Gotcha. That's the entirety of the question there. So maybe we'll jump to the next one while they give me a little bit of clarification there. Moving on to the next one there. Let's see. We've got a lot of great questions here. You guys can keep them coming, please. Ooh, here's a long one. Let's see if I can get all this one out. What happens if an investor's note matures, doesn't want to offer an extension, and wants their money returned, but you as a founder don't have the funds to repay them? Guys, that typically does not, I wouldn't say ever happen, but have you guys ever seen an investor outside of extraordinary circumstances actually just ask for their money back with the interest?
I've seen it. I have seen it, and it usually means that the investor who invested was not very, they weren't very sophisticated. They didn't necessarily understand what they were getting into, and they did really look at it as debt that was going to be paid back one way or the other. When in fact, in all practicality, there's just no way that that's ever going to be paid back. Especially at a seed round when you're really raising money in anticipation of an equity round of financing later on. So I have seen it, and basically all you can do is say, we don't really have any money, and if you're actually going to, demand the money back, you're basically forcing us into bankruptcy, which obviously doesn't do anyone any good. And so typically, when that happens, you go back to them and you negotiate, you explain, and you try to, make them understand that really the goal is to raise a round of financing, and that we don't have money to cover the actual principal that the investor wants to be paid back.
Yeah, I agree. I have seen this, and it's absolutely a question of a lack of sophistication on the part of the investor at the time of the investment. And the answer is, the answer sort of is no, we can't do that, but not in those words. The answer is walking the investor through the scenario. Often the convertible note requires that a distribution be made to every single investor in convertible notes. So you don't even have the opportunity to say, okay, you only invested $10,000, so sure, we'll give you back your $10,000. You probably can't do that, legally speaking. You probably will have to make a distribution to everybody. And let's say the round was initially $500,000, and you've got $63,493 left in your bank account right now. Best case scenario, you liquidate and you pay back investors on a pro rata basis. The amount, the principal they invested, which means they're going to get pennies on the dollar, and so if you sort of walk through the scenario, it's pretty unlikely that an investor is going to hold fast to that position, recognizing that it's going to force a bankruptcy. And by the way, going through a bankruptcy is going to incur not insignificant amount of legal fees, which will come out of the cash on hand, further reducing the payback to the investor.
Yeah, Kevin, that's a good point, because I actually wasn't thinking about along the lines of a small investor that was part of a convertible note. The one that I was thinking about was, where we had a major investor, or in this case, actually, it was only investor who wanted, out, and basically just decided that the company was not going to be successful and was trying to cut his losses. And so demanded, repayment back, which really, there was really no money to be paid back, and so it became from a practical standpoint, it really didn't matter what the request was or the demand was. But that's a really, really good point, and I imagine that happens also with unsophisticated investors who have put in maybe $10,000 or $20,000 into a $200,000 convertible debt, right?
Absolutely.
Yeah, so that's a really good point, because in that case, a company would have the money if they wanted to just say, "Hey, I'm done," or I'm going to just pay you out and have you be gone. And the founder may be interested in doing that, but legally they probably wouldn't be able to do that.
And think back, even beforehand. I mean, these kinds of sometimes you can anticipate these kinds of questions coming from an investor at the time of the investment. It really ought to be some real red flags in your conversations with investors if they're asking you about payback, if they're really hard negotiating things like demanding a greater discount than 20% and so on. They recognize that an investment is a sale, and sometimes you don't want certain customers.
And to kind of tie into that a little bit, are convertible notes ever negotiable if both parties are amenable?
Sure.
Yeah, and I think the question is more like in the middle, more after the original terms have been accepted. Like if there's a reason to come back to the table to renegotiate terms. Do you guys ever see anything like that?
Yeah, you do. You hate to see it, and I'd take it as a red flag again. But sort of answering the question on its face, absolutely, they're negotiable. And in one sense, every transaction is a negotiation, right? It's just that over the past several years, those negotiations, done tens of thousands of times across the United States, have resulted 90-some% of the time in the very same outcome. So 20% discount, an 18 or 24-month term, and so on. Which is why I generally say there's not much to negotiate. You really shouldn't negotiate, but it happens, absolutely. Now, if the scenario that we're concerned about here is we've got a commitment from an investor to put in $100,000. He's already seen the convertible note purchase agreement, the convertible note. Generally signed off. We haven't actually closed the transaction, and the investor comes back and says, "You know what? Thinking a little bit more about your projections, I just don't see that happening. I really think that the company ought to be giving us a better note cap." That happens.
If the question is, can we negotiate or renegotiate the actual terms of the note after it's been agreed and signed and money's come in, I've never seen that. I'm trying to think of a scenario when that would happen. But yeah, I imagine they could ask for it. Kevin, have you seen that where someone has come back after the fact and said they want to renegotiate?
Not in the startup space.
Okay. Yeah. Okay.
No.
All right, great. Market conditions for convertible notes, do those kind of rise and fall along with the general environment for seed and Series A funding, or how? Are there certain times of the year or trends that you guys see specifically with the environment for convertible notes specifically?
Sure, like any investment or any security, macroeconomic factors play a pretty sizable role, as do sector-specific factors. So, a year and a half ago, when people were starting to talk about too much froth in the tech sector, and even some VCs and some other investors announced that, hey, we're not going to be doing any investments for a while because we think valuations have just gotten way out of whack. We did see things like convertible notes, companies providing convertible notes with no convertible cap, no discount. I think that was it was a spike. I think it was out of whack with common sense, and it didn't take long for those kinds of terms to disappear. I haven't seen those again, in at least a year, and we're back to kind of the normal 20% and normal maybe $4.5 million note cap for a seed stage company with some amount of traction.
I have seen, in the past also, and it also depends on investor too, because the more sophisticated they are, the more they have their finger on the pulse in terms of the market. I have seen some, strategic investors who get into, who want to loan company money to get started. Maybe it's a partner, maybe it's a sales partner, and they'll provide some cash. And with those guys, maybe they're not that sophisticated, and they're perfectly happy with a convertible note with no cap, right? Which is obviously disadvantageous to them. But it's just not that important to them, and we've seen stuff like that. But right now, yeah, we're kind of back to the norm of 20% with some cap in the 4 to 6 range for a lot of tech companies in the seed stage.
All right. Are there any times or any specific scenarios where either of you would recommend not leveraging convertible notes and just using the traditional equity investments from the founder perspective?
Well, the only one that I can really think of is where if you have a founder, for example, who's already experienced, who's already done one or more startups, has had successful exits, is a known quantity in the investment community, and is basically the kind of person who could pick up the phone and talk to VCs and get a lot of money on slideware. And we know people like that who can get really, really good terms on an equity round of financing from the get-go. Then sure, why not? If you can raise a lot of money initially without needing a seed stage convertible debt amount, then yeah, I can see it, and we see entrepreneurs who do that. But for new entrepreneurs, I think that that's going to be very, very difficult. We're probably not going to be as experienced. It's going to be easy for investors to potentially take advantage of us. So from a founder perspective, if you're a new founder, first timer, I would highly recommend against it. Raise a seed round of financing, do as much as you can, hit as many milestones as you can with that to get the valuation of the company up at that Series A, and go and grow from there.
Yeah, the other scenario that we didn't really talk at all about today is a reasonably new a new form of investment agreement, which is the SAFE, stands for Simple Agreement for Future Equity. It's essentially taken a convertible note, all the advantages, all the good things of a convertible note, and removed the specifically debt features of interest and term. And it's just an investment contract, like kind of any investment contract, even more simple than a convertible note agreement. Become reasonably popular, at least in the tech industry in certain places, and I think it's certainly something that a seed stage founder should consider in lieu of a convertible note.
Yeah, I didn't know if we were going to go there, Kevin. I agree, and it's probably something that you could do a little bit of research online to see kind of what it's about. I think from a founder perspective, it makes a lot of sense, and more investors are getting savvy about it. And when you have the two sides who understand kind of what it is and how it works, and it's agreeable, then it makes a whole lot of sense. I think in many cases, I'm still finding that convertible notes though is much more popular, much more well known, And you know, most investors, you're not going to have to explain it to any investors, as opposed to safes, which you might have to, and that'll just kind of, you know, create another cycle of discussion and decision making, you know, which isn't necessarily what we want at this stage. But yeah, please research it, and it's for founders, it's a great option.
I've got an interesting one here, a fun one, I think, and maybe we'll do one of each for both of you. But do you have any horror stories from founders using convertible notes? I guess we'll sit around the campfire here. Kevin, you got any ghost stories of you know, tales of woe or warning for any kind of might have gotten a little in over their head with this instrument?
Yeah, we don't have enough time to tell all those horror stories, but or enough beer at the moment. But you know, one of the ones I think that is the hardest to go through is exactly the scenario that we talked about earlier. A small, unsophisticated investor realizes a year in that this wasn't quite what she thought it was going to be, and wants her money back. And that leads to a lot of uncomfortable conversations. They're uncomfortable for both sides. Lawyers probably are involved. You start incurring fees. As we said, it's probably not likely at all that you're going to be able to return money, even if you want to. But you clearly would love to be rid of this investor. So you're probably, you know, at the company side, you're probably a little conflicted, and it's a difficult conversation to have. It drains time, energy, far out of proportion, in my experience, with the amount of dollars that are at stake.
Yeah, and I think that is the classic horror story. Hope nobody ever experiences that. I've certainly experienced it. But you know, let me bring it back a little bit in time, and kind of point to again to one comment that Kevin made, which is that, you know, we probably can see signs of this right at the onset. You know, if they're asking all kinds of questions, trying to understand what to expect, you know, ask questions like, well, what happens if I decide I want my money back 6 months from now? You know, what's the process there? You know, if you start getting questions like that, or even during the initial, you know, negotiation phase, you know, you're getting tons of calls and emails from them trying to understand. You know, those are really early signs, and signs before you get into the agreement, that maybe this is not the best person to work with. You know, and you know, I've seen, you know, cases where, you know, there's a group of, you know, 4 or 5, you know, investors who want to do it, and you end up, as the founder, you end up talking with one investor who's only, you know, 10% of the deal, and they're calling you constantly before the agreement is actually even signed. And so, you know, to me, that's a horror story, because that's, you know, you're not only spending time now before the agreement, but it's almost a certainty that you're going to be spending a lot of time with them afterwards, much more than should be commensurate with the amount of investment. And so, you know, it's probably a really, really good sign that even though you need the money, even though it'd be nice to have that money, you got to be thinking long term about the amount of effort and energy and basically, you know, just brain cells that you're going to be saving by not getting into a deal with that kind of a person.
All right, I think we've got time. We're going to squeeze one more in here. It's actually a few different questions, kind of. I'm going to see if I can do my best to just paraphrase into one. Lots of great questions again this time. Thank you, everybody. So when you're approaching investors for traditional investment, at what point should the conversation turn to convertible notes? Should that be in the pitch deck? Should that be after you've secured or you've at least received a handshake on traditional equity investment? At what point should founders be prepared to inject convertible debt into, you know, their model for investment?
I think you should go out and the very first thing that you send to an investor. It's not the primary topic of conversation, but let's say the first deck that you actually send to an investor, assuming you've already had a conversation or at least had an email introduction or something. And so the first deck is maybe 8 to 12 slides, and probably in about the back there's a slide something along the lines of raising $1 million in convertible notes. Simple as that.
Yep, completely agree.
Nice. Love answering several questions that quickly. Gentlemen, I think we've reached the end of our time today. Thank you both for your insight and answering a lot of these questions. Thanks to all of our attendees for joining us. There will be a recording of this entire webinar that will be both sent out to all registrants within 48 hours, as well as up on our YouTube channel for Early Growth Financial Services by the end of the week. So we'll have all that to you as fast as possible. If you have any additional questions that might not have been answered today, we've got contact information here up on the slide in front of you. Sirk, thank you again for attending.
Thank you very much, everyone.
And thank you, Kevin.
My pleasure.
All right, take care, everyone.